The eviction notice listed a company as the owner of his home, and he had never heard of it. Walter Green read the document at his front door in Orlando, Florida, and checked the name again. Sunridge Property Group, LLC. The notice stated that the company had acquired the property through foreclosure and that he was required to vacate within 10 days. The document included a case number, a court seal, and a date that showed the process had already been completed. Walter had no mortgage. He had owned the house outright for nearly 12 years. He went inside, sat at the table, and reviewed every line again. The notice referenced missed payments, a default, and a foreclosure judgment. None of it matched his financial history. There had been no loan, no lender, and no communication before this notice. Walter called the number listed for the court. The clerk confirmed that the case number was valid and that the foreclosure had been processed weeks earlier. The plaintiff in the case was Sunridge Property Group, LLC. The defendant listed was Walter Green. The system showed that he had been served legal notice and had not responded. Walter had never received anything before this. He went to the county records office the same day and requested all documents tied to his property. The file showed a sequence that explained everything on paper. A mortgage had been recorded against his home 5 months earlier. The lender listed was a private entity connected to Sunridge Property Group. The mortgage showed his name and what appeared to be his signature. 3 months after that, a default notice had been filed. Then a foreclosure action. Then a judgment. Then a transfer of ownership to the company. Each step had been recorded properly. Walter was no longer the owner, according to the records. He took the documents to a real estate attorney. The attorney reviewed them and identified the structure immediately. Someone had created a fraudulent mortgage using Walter's identity, recorded it against his property, then used that mortgage to initiate foreclosure when payments were not made. Because the documents were filed correctly and Walter never responded to the notices he never received, the court process moved forward without challenge. The house had been taken through a legal process based on fraudulent documents. The timeline showed the method clearly. Before the mortgage was recorded, a change of mailing address had been submitted for Walter's property records. All official notices related to the mortgage and foreclosure were sent to a different address. Walter remained unaware of every step. At the same time, someone had gathered enough personal information to pass identity verification. The mortgage application included identification, financial details, and a signature that matched closely enough to pass review. The lender listed on the mortgage was not a traditional bank. It was a private entity created to issue the loan. That meant fewer verification requirements and faster processing. Once the mortgage was recorded, it became a legal claim against the property. The foreclosure process followed automatically after the staged default. Walter's attorney filed an emergency motion to challenge the foreclosure and halt the eviction. The argument was based on fraud, but reversing a completed foreclosure required strong evidence and time. The eviction timeline was much shorter. Walter checked his credit report. The mortgage appeared under his name, along with a history of missed payments. The address associated with the account was not his. It had been changed before the mortgage was issued, and then changed back after the foreclosure was complete. This prevented him from receiving any alerts. The fraud was structured in layers. First, redirect communication. Second, create a mortgage. Third, allow default. Fourth, complete foreclosure. Fifth, transfer of ownership. Each step relied on the previous one being accepted as valid. The company, Sunridge Property Group, LLC, had been registered shortly before the mortgage was recorded. It had no operating history and no physical presence. The contact details linked to it were temporary. The mortgage funds were never intended for legitimate use. The money moved through accounts controlled by the same group and was withdrawn quickly. The purpose of the mortgage was not borrowing. It was creating a legal pathway to foreclosure. Walter's attorney worked to reconstruct the timeline with evidence. Handwriting analysis showed the signature on the mortgage was not Walter's. The identification used in the application contained inconsistencies under detailed review. The mailing address change request became a critical point. It had been submitted in person at a local office. Surveillance footage showed an individual presenting identification and completing the form. That identification matched the one used in the mortgage application. This connected the actions. Authorities linked the case to a group targeting properties without existing mortgages, especially those owned by retirees. These properties allowed fraudulent mortgages to be recorded without interference from other lenders. The method depended on silence. If the owner did not receive notices, the process continued without interruption. Walter's case was not isolated. Similar foreclosure patterns were identified in multiple counties, all involving newly created companies, fraudulent mortgages, and redirected communication. The court reviewed the emergency motion and granted a temporary halt on the eviction. This stopped the immediate removal, but did not resolve ownership. The property remained listed under the company's name. The legal process to reverse the foreclosure required proving that the mortgage itself was fraudulent. Without a valid mortgage, the foreclosure had no legal basis. Weeks passed as evidence was presented. The attorney demonstrated that Walter had never applied for the loan, never received funds, and never signed the documents. The notary listed on the mortgage admitted that identity verification had not been properly completed. That weakened the validity of the entire chain. The court reviewed the sequence of events and identified the dependency on the fraudulent mortgage. Without it, the foreclosure could not stand. The ruling declared the mortgage void. That invalidated the foreclosure. That restored ownership. The county records were updated to remove the mortgage, cancel the foreclosure, and return the title to Walter. The eviction notice became unenforceable. Walter remained in his home, but the process had taken months. During that time, the system had treated the fraudulent documents as valid and had nearly removed him from a property he had owned for years. He implemented monitoring alerts on his property records and secured his personal information to prevent further attempts. He also registered for notifications on any filings related to his name. The structure that allowed the fraud remained unchanged. It relied on documents appearing valid at the moment they were submitted. The eviction notice was real. The foreclosure had been processed. The ownership had been transferred. All of it had been built on a mortgage that never should have existed. And until it was proven false, it was enough to take his house away.